been a while, hasn't it? So how's the first quarter of the year been for you? Anyone else getting massive amounts of trouble for having an extremely private part-time financial firm, which ultimately led you to lose your job and force you to take the part-time firm full-time? Anywho, it's so great to speak with you all, and I'm excited I'll be publishing more video content. Taking a step back, for those of you who don't know me, my name is Scott Lanigan, and I'm pretty much everything at EID Capital. Today, however, I'm going to throw on my CIO hat to provide some first quarter 2024 market commentary. Also, I'll link the disclaimer below, but the main things to keep in mind are that this video is for informational and educational purposes only. This isn't a solicitation for EID Capital services, and finally, past performance isn't indicative of future results. So let's get started, starting with how the major indices fared in the first 3 months of the year. As you'll see, the S&P 500 rose to new records to close out a monster first quarter, the best performing first quarter since 2019, and touching 22 new all-time highs in the process. A resilient economy, excitement centered around emerging artificial intelligence technology, and expectations for short-term rate cuts were the primary drivers of strong Q1 performance. Looking further, the growth in tech-heavy NASDAQ composite returned 9.31%, and the boomer Dow Jones Industrial Average returned 4.5%. Rounding out the major U.S. indices, the Russell 2000, an index holding small company stocks, returned 5.18%. Looking around the world, the Europe, Australia, Asia, and Far East Index, also known as the FE Index, returned 5.78%. The Emerging Markets Index, which makes up countries whose economy and capital markets are considered developed, performed their worst. Now let's dig deeper into individual sector performance within the S&P 500. Energy was the strongest performing sector, which is a little surprising given the reams of AI and tech-related headlines. The sector as a whole returned 13.51%, which was largely attributable to strong energy commodity performance, particularly oil. Crude oil rose 18.28%, and Brent crude appreciated 16.41% in quarter one. However, if a company's production mix and asset portfolio tilts more toward natural gas, their stock likely suffered as natural gas fell 21.32% in Q1. Communication services was the second strongest performing sector, appreciating 12.68%. This was mostly due to company-specific reasons and not sector-wide macro factors like commodity performance and the energy sector that we just discussed. The top three contributors for strong sector performance were Meta, returning 37.33%, Disney, returning 35.52%, and Netflix, returning 24.75%. Generally speaking, all these companies performed strongly due to positive re-ratings from stronger than anticipated earnings, coupled with numerous analyst upgrades over the quarter. Finally, financials were the third best performing sector, returning 12.44%. Warren Buffett's holding company, Berkshire Hathaway, returned 17.91% and was the largest contributor to sector outperformance. Zooming out more broadly, positive macroeconomic news coupled with expected future rate cuts propelled big bank outperformance. Now, on the other end of the coin, real estate performed the worst and was the only sector to post negative returns in Q1, declining 65 basis points. Broadly speaking, macro factors create headwinds for the sector. An increase in 10-year interest rates caused trouble on two fronts. One, it caused a decrease in real estate valuations as properties are commonly priced against this 10-year treasury rate. So as interest rates increase, if there isn't an adjustment to risk premiums, called cap rates in the real estate sector, real estate values will fall, all else equal. This hits richly valued real estate types that have high debt placed on them particularly hard, like multifamily and industrial investments. Then second, and alluded to, higher interest rates increase the cost of debt capital, which is problematic for operators with floating rate debt and the transaction market, as higher debt financing costs increase the required return on capital for deals to pencil. Sticking with real estate, another theme emerged when diving even deeper into the sector. Telecommunications infrastructure companies were some of the worst performers in Q1. American Tower Corp, SBA Communications Corp, and Crown Castle Inc. all have fairly high debt loads, and the telecom infrastructure industry is a fairly mature one in terms of mobile coverage and mobile data usage, as everyone and their mother already has several mobile devices, limiting future growth opportunities. Although I touched on a few stocks already, let's dive into the performance of some of the best and worst performers in Q1. First, NVIDIA Corp, the AI sizzle stock that's delivering the steak. NVIDIA has been the poster child for AI as their graphic processing unit, GPU, chips are widely used in AI applications, particularly for deep learning and machine learning tasks such as training neural networks and large data models. And as these AI models become more complex and data intensive, there will be growing demand for high performance computing solutions to support these workloads. Because of NVIDIA's dominance in the GPU market and their premier chip quality relative to competitors, they are positioned as the best pick and shovel play in the coming AI gold rush. Next, Meta, who's exceeding previously low expectations and has potential upside and downside legislative risks. Cost cuts and increased capital discipline after a disastrous 2022, in which Meta slumped 64% due to negative revenue growth and disappointing profitability, have started paying off for this company. This is highlighted by their better than expected Q4 earnings report, in which their stock appreciated 28% the day after they announced. Looking further, legislation aiming to ban TikTok will benefit Meta's social media platforms, particularly Instagram Reels, as more eyeballs and attention will be turned to their applications. All is not green on the legislative front, however, as Meta has an FTC lawsuit pending, which is scheduled to be heard in 2024. The lawsuit is centered around antitrust concerns from its prior acquisitions of Instagram and WhatsApp. And finally, excitement over Apple's Vision Pro reignited enthusiasm over the future of augmented and virtual reality headsets. Meta is positioned to benefit on the hype as it sells their own more affordable AR/VR headset through its Oculus business segment. Finally, discussing the poor performance of Tesla with the theme of slowing EV demand and growing Elon risks. In the first quarter of 2024, Tesla's deliveries were hit by soft orders in China and increased domestic and global competition in an electric vehicle market that's seeing waning demand for EVs. Speaking specifically to China, I'm assuming more Chinese consumers prefer their domestic electric vehicle counterparts like BYD company, whose electric vehicles may be at par or exceed Tesla's cost-benefit value proposition. Then Elon. Elon Musk, for better or worse, but mostly better in my opinion, is a significant key man risk for Tesla. Investor sentiment has soured on him after the Wall Street Journal published an article over his drug usage. In addition, Elon has endured increased regulatory scrutiny over concerns on Tesla's board independence. Finally, he's spending an increased mindshare on his latest business acquisition, X, formerly known as Twitter, versus Tesla. When you have to spend more time, energy, and attention across more businesses, you're diluting your human capital allocated to any one business, like Tesla. Now let's take it international. Looking abroad, Japan was the best performing country in the FE index in Q1. The company returned 11.24%, which was largely attributable to macroeconomic factors. The Bank of Japan, their Federal Reserve, announced that they will end their 8 years of negative interest rate policy by increasing their short-term interest rate range to 0 to 0.1%. Not much, but, it counts. They also announced that they would abandon other unorthodox capital intervention policies such as yield curve control and buying up risky assets to boost asset prices. The pivot in the BFJ's policy was largely due to inflation and labor market strength. As an example, Japan is currently facing a labor shortage, which contributed to labor unions and the largest Japanese companies agreeing to the biggest wage hike in 33 years. Now, Australia was the worst performing country in the FE index, returning 1.31%. Australia's stock market is highly dependent on industrial metal commodity prices, particularly that of iron ore, in which Australia is the leading producer and exporter of the commodity. Well, iron ore dropped 27% in Q1, which negatively affected Australia's largest diversified natural resource companies like BHP and Fortescue, which declined 13.83% and 8.92% respectively. However, despite this, we can see that Australia still squeezed out a positive return. This was mostly due to strong performance of Australia's big banks, suggesting better than previously expected economic activity in the country. Now, moving over to emerging markets. Taiwan was the strongest performing emerging markets country, returning 5.76%. This is pretty much because of Taiwan Semiconductor Manufacturing Company's stock performance, which returned 31.34% in Q1 and makes up 25% of the index. Broadly speaking, so goes the demand for semiconductor manufacturing and foundry needs, so goes Taiwan's stock market, sans any China-related geopolitical risk. Brazil is the worst performing emerging market, declining 7.27%. Brazil's story is similar to that of Australia's, as Brazil is the third largest producer and second largest exporter of iron ore. Vale, a multinational mining company and the largest company in the MSCI Brazil Index, gets approximately 2/3 of their revenue extracting and selling iron ore. So, because of this negative commodity price development, Vale's stock dropped 19.72% in Q1, causing a significant drag on Brazil's market. Now that we're done discussing equities, let's discuss U.S. fixed income markets. The Federal Reserve held rates steady at the current 5.25 to 5.5% range in Q1. However, rates rose across the yield curve for the quarter, with the 3-month Treasury rate rising 6 basis points to 5.46%, the 2-year rate rising 36 basis points to 4.59%, and the 10-year Treasury rate rising 32 basis points to 4.2%. Credit spreads decreased across the board as better than expected economic strength and corporate profits decreased perceived credit riskiness. It decreased the most for high-yield CCC rated bonds, with spreads decreasing 44 basis points, and the least for AAA bonds, which decreased 2 basis points. Generally speaking, when the economy and corporate profits are strong, spreads decrease, benefiting low-quality bonds with the most, and when the economy is weak, the companies are under duress. Spreads typically increase, leading AA bonds to outperform lesser quality fixed income securities. So given these results in Q1, it paid to be in lower duration, lower credit quality securities. And if you're on the other end of the spectrum, holding long duration, high quality bonds, your fixed income holdings likely lost value. And finally, let's discuss the U.S. economy. The United States grew at an 3.4% annual rate in Q4 2023, down from the 4.9% annual rate posted for the third quarter. This was primarily driven by a 3.3% increase in personal consumption, which accounts for approximately 2/3 of U.S. GDP. However, personal income increased by an average rate of 0.53% over the past 3 months ending February, which comes out to a 2.13% annual rate. Pair this with dwindling excess savings, high consumer debt levels, and increased interest costs beginning to cause a rise in credit delinquencies. Maintaining a 3.3% personal consumption growth rate may prove difficult going forward. As previously mentioned, the Federal Reserve held their rate steady at their 5.25 to 5.5% target range, and 10-year Treasury rates increased 32 basis points to 4.2%. So we're still in this awkward yield curve environment where it pays more to keep money in cash versus invest it in longer dated bonds and risky securities. Inverted yield curves have historically been a reliable indicator of soon-to-be recession, but based on what we'll go over shortly, this time may be different. Famous last words, I know. All right, so digging into the inflation numbers, over the past 3 months ending February, the Consumer Price Index, the CPI, increased about 1%, which annualizes out to around 4%. Looking at the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Index, the index increased 1.51% over the same period, which annualizes to 6.05%. Now, when looking at core inflation numbers, which strips out more volatile food and energy categories, over the past 3 months, core CPI increased 1.03%, which is an 4.11 annualized rate, and the core personal consumption index increased 0.87%, which annualizes to 3.46%. Looking at labor market indicators, the unemployment rate crept up to 3.9% in February versus 3.7% in January. While slightly concerning if it starts to become an upward trend, keep in mind that this is far below the 5.7% long-term unemployment average, although times of economic distress skew this average upwards a little bit. Average hourly earnings over the past 3 months grew at an 0.99% annual rate. However, after accounting for inflation, average hourly earnings over the same period were literally flat at 0%. So with these developments in mind, the Federal Reserve stated that they expect to cut rates 3 times in 2024, likely down to the 4.5 to 4.75% range. But they also stated that they are in no rush to do so until they are sure inflation is on track to meet and sustain a 2% rate. So what am I looking at? Looking forward to the second quarter, there are 2 themes to look out for. First, inflation data and rate cuts. The Federal Reserve's next interest rate decision meeting is in May, and then they meet again in June. It's currently expected that they will keep rates steady in May, and as previously mentioned, start cutting rates in June. The expected June rate cut will be heavily dependent on inflation and labor market readings that occur before then, however. And when looking at the CPI and PCE readings, we seem to be a long ways away from their stated 2% goal. So higher than expected inflation with continued labor market strength could lead the Federal Reserve keeping current rates steady for longer. This could cause some downward price pressure in financial markets. Now, the next theme I'm keeping an eye on are Q1 2024 earnings releases. Will AI continue to deliver or disappoint? With the S&P 500 trading rich at a 27 PE versus a 20 PE historic average, future stock performance will be sensitive to any Q1 earnings disappointment, especially in the AI, hype-driven technology, and communication service sectors. To illustrate, out of the top 10 companies in the S&P 500, 7 of them are in the tech and communication service sectors and make up a little over 25% of the entire S&P 500 index. So I would be on the lookout for earnings announcements on the week of April 22nd when Microsoft, Meta, and Google are all expected to report earnings. Also that week, look out for the earnings announcement for the CPU chip maker Intel, who reports on April 26th. Intel's results could be a canary in the coal mine of sorts, in providing a sense of whether the AI hype is overblown or if there's room for the theme to keep running. Sticking with the AI theme, keep an eye out for earnings announcements for the rest of the major semiconductor companies. This includes Advanced Micro Devices, AMD, which is expected to report May 2nd. Previously mentioned NVIDIA, which is expected to report May 31st, and the dominant chip foundry company, Taiwan Semiconductor Manufacturing Company, which is expected to report on April 19th. Finally, given the strong Q1 return performance of Netflix and Disney, I'm interested to see how they continue to perform based on their Q1 earnings results. Netflix is expected to report on April 18th, and Disney reports May 10th. Disney in particular is interesting given that similar to Netflix in 2020 and 2021, they're pulling back on pouring money into any and all content, which has resulted in significant IP brand dilution, particularly in their Marvel and Star Wars assets from pumping out crappy shows tied to these IPs. But recently, Disney has signaled that they're going to be much more disciplined in deploying financial and human capital by concentrating their creative firepower on less content, which should lead to better content overall. I guess we'll see. I'm not even a big comic book guy, but I always perk up when I see battles between the creatives and the suits. So that's all I have for you today for current EID Capital clients. Be on the lookout for an additional video in which we'll discuss portfolio performance, the underlying security performance in those portfolios, how tactical positions are performing, and how I'm positioning portfolios going into the second quarter. As always, thank you for watching, and please reach out if you have any questions. I'll leave my calling card at the end of the video so you know how to reach out, and I'll leave a link below to sign up for my newsletter so you won't miss out on any new content. All the best, y'all, and I hope to see you soon. See ya.